All right, let's talk about gold futures. Today, we are going to pull back the curtain and see how this market really works. And look, this isn't just for day traders. Understanding this stuff gives you this incredible behind the scenes look at the real demand for physical gold.
Have you ever wondered what on earth is COMEX? Or who are the actual people, the buyers and sellers, who are making the price of gold tick up and down every day? And how does that connect to the price you see on the news? Well, if you have, you are in the right place because we're about to break it all down.
So here's our game plan. We're going to tackle this in 5 simple steps. We'll start with the basics, the contract itself. Then we'll look at the 2 sides of every trade. From there, we'll get into the really interesting part, physical delivery. Then we'll cover the role of the exchange, the market's safety net. And finally, we'll put it all together to see why this data can give you a serious edge.
Okay, let's dive right in. Before we can understand the whole market, we have to start with the single most important piece, the futures contract itself.
At its very core, a futures contract is just a promise. It's a simple agreement to buy or sell gold at a price you lock in today, but for a transaction that will happen sometime in the future. And for gold, the main stage where all this action happens is the COMEX exchange.
Now, when we talk about a contract, we're not talking about a couple of gold coins. Nope. A single, standard gold futures contract on the COMEX represents 100 troy ounces of gold. That's a serious amount, and it's the standardized unit that keeps the whole market ticking.
Let's try to wrap our heads around that. If gold is trading at, let's say, $4,000 an ounce, that one little contract controls a staggering $400,000 worth of gold. That is a massive amount of value tied up in a single digital agreement. But here's where the magic and, the risk of futures comes in. You don't actually need the full 400 grand to trade that contract. Instead, a trader just puts down a small deposit, which we call margin. It might only be around $20,000. This is called leverage. It's the power to control a huge asset with just a little bit of capital. It can amplify your gains, but it can also amplify your losses just as quickly.
All right, so every single trade that happens has 2 sides, right? A buyer and a seller. Let's dig into who these players are and what they're trying to do. It's actually beautifully simple. On one side, you have the buyer. We call them long. They're betting the price of gold is going to go up. On the other side, you have the seller, who we call short. They're betting the price is going to go down. The buyer agrees to buy gold in the future at today's price, and the seller agrees to deliver it. It's a classic tug of war. And this brings us to a really crucial point. The vast majority of these traders are just speculating on the price. They have absolutely no interest in getting a truckload of gold bars delivered to their doorstep. They just buy a contract, and if the price moves their way, they sell an identical contract to close the position and take their profit, or their loss. No physical gold ever moves. But what about that small group of traders who actually do want the physical metal? Well, this is where it gets really fascinating. Their actions are all tracked in a public report from the exchange, and it gives us this amazing window into what the real physical demand looks like.
So this is a super simplified version of what you'd see in one of those official reports. At first glance, it just looks like a bunch of names and numbers, right? But it's actually telling a very clear story about who is taking delivery of gold and who is handing it over.
Let's decode those terms, because they're the whole key. If a firm issued contracts, it means they were a seller, and they had to deliver physical gold. If a firm stopped contracts, it means they were a buyer, and they received physical gold. Simple as that. Issued is giving, stopped is getting. And there's one more little detail that's super insightful. You'll see either an H or a C in the report. H is for house, which means the big banker firm was trading for its own account. C is for customer, which means they were doing the trade for one of their clients. This tells you if it's the big institutions moving metal or if their clients are demanding it. Okay, so with all this money and all these promises flying around, you might be thinking, what stops the whole thing from just collapsing? Well, that brings us to the hero of the story, the exchange itself. I mean, it's a fair question, right? Imagine you've made a great trade. The price has moved in your favor, and the person on the other side of that trade, the one who's losing a ton of money, what if they just decide to walk away? Does your profit just vanish? The answer is a big, fat no. And here's why. You are never actually trading directly with another person. Both the buyer and the seller are making their trade with the exchange's clearinghouse. It stands in the middle of every single transaction.
It's the buyer to every seller and the seller to every buyer. It guarantees every trade. So if someone defaults, the exchange steps in and makes you whole. It's the bedrock of trust that allows this entire global market to function. Okay, so we've covered the what and the how. Now for the most important part, the why. Why should you care about any of this? How does watching this delivery data actually give you an edge? This is where the rubber meets the road. It's a simple if-then situation. If you start to see a lot of contracts being stopped, meaning people are demanding the real physical metal, then it signals that physical demand is strong, and that is usually a bullish sign for the price. On the flip side, if you see delivery numbers dry up, then it suggests demand for actual gold is weak, and that can be a bearish signal. Now, of course, this data isn't a crystal ball. You don't look at it in a vacuum. But when you take these signals about physical demand and you combine them with the big picture stuff, like what inflation is doing, where interest rates are headed, and the trend of the US dollar, you start to get a much richer, more complete view of what's really driving the gold market. So let's just quickly recap the absolute must-knows. 1. Futures are all about leverage, using a little money to control a lot of gold. 2. When it comes to delivery, stopped means you're getting the gold, issued means you're giving it. 3. The exchange is your safety net. It guarantees every single trade. And 4, and this is the big one, high physical delivery is a powerful sign of strong demand. So there you have it. We've just peeled back a layer of the market that most people never, ever see. You now know the language of physical delivery. You understand the mechanics that the pros are watching every single day. So the only question left is, now that you know what to look for, what will you see?